How is everyone doing? Good. Alright, so the first thing I'm going to do is I'm going to kind of change the energy of the room by asking you to just change your seat. Meaning just move from where you are to somewhere else. That's all. Change the below. Plus you look very cool. Cold. Well, the person behind you actually. Y'all hear that? The buzzing. It's activity, meaning what I'm saying is it was a little bit quiet, a little bit drab. So I wanted to get the attention span kind of more focused on me. In asking you to do something, you had to listen to me and then you had to execute the action, yes? Alright. So this afternoon, I believe your president already gave the introduction. My name is Devrhoid Davis. I am the co-founder and CEO of Caribbean Value Investor Corporation. And today I'm going to be talking with you a little bit about the concept of value investing. And specifically, we're going to be looking at the 7 P's for successful value investing. So here's an outline of what we're going to be talking about. You're going to get to learn a little bit about me, an introduction and a background. You will also learn a little bit about my investing journey. I started investing over 6 years ago. Then we'll talk about what value investing is and why it is my chosen approach or philosophy to investing. And then after that, we will actually look at some value investors which I'm sure you know, though you may not know them as value investors. But I guarantee you, that will not surprise you. And then we will talk about the 7 P's for successful value investing. And yes, they are bland intentional, so that you have to pay attention. All right? And then lastly, we'll look at some key takeaways that I will actually get from you. And then any questions you might have for me, I'll make myself available. We're good with that? Awesome. So a little bit about me. Firstly, I am an investor. I am a graduate of the University of the West Indies. I should mention that. That's pretty obvious. Right? I'm also a graduate of Clarendon College. And I graduated from the Department of Science and Technology. My bachelor's degree is in bioengineering and medical physics with another major in electronics. And I can program in 40 programming languages. My passion is for analysis. I have built my own investing library now to well over 50 books on the topic. And I've read through most of them. And in my spare time, I enjoy pretty much watching videos from Investor Archive or talks at Google. Typically, these are about 1-hour videos from successful investors. I like billionaires, so that's what I do. Interestingly, key point well, not a key point, but just a side note. Somebody has been recommending to me for the longest while to watch a show called Billions. Anybody watches it?
Yeah. Yes. Yes. You guys would be imposters if you had not watched Billions. They would all be imposter investors if they did not watch Billions.
Okay. Well, I don't watch Billions.
He's an imposter.
All right. And then for me, in my experience, I currently run Caribbean Value Investor Corporation. I'm also the host of a YouTube show called Beyond the Stock Price. And if you follow Kalila Reynolds, you'll probably have seen me on Taking Stock as well. My social media handle across all platforms is Devrhoid, it's my first name. And that's pretty much, I want to think most of the things you want to know about me. I am not a financial advisor. I am an investor, all right? So therefore, let me insert my favorite disclaimer here. All the information I will pass on to you today is strictly for educational and information purposes only. It is not intended to be construed as financial advice and it is by no means a recommendation for any stock in particular. Okay, so my investing journey. As I mentioned earlier, I started investing in 2013. This was before Jamaica Stock Exchange was the best performing stock exchange of all time. It was before we had IPOs that would give you 400% return on your money. It was before we had taxi men investing in stocks. I started investing with $6,000. And the first stocks I bought were in the Lasco group of companies. I bought Lasco Financial, Lasco Distributors, and Lasco Manufacturing. I bought all of them way too expensive. And we'll talk a little bit about how do you know if a stock is too expensive. Key point, a stock that is selling for 50 cents is not necessarily a cheap stock. All right?
Or $1.
Fast forward to today, and I manage a 7-figure portfolio. I won't tell you where on the scale of 1 to 9 that is. And I'm a shareholder in all of these companies and many more. My investing philosophy has always been that of value investing. And for now, I'm going to tell you just a little bit about what value investing is and why I actually chose that approach to investing. So the term value investing was actually coined by Benjamin Graham. Is anybody here familiar with the name Warren Buffett? And does anybody know Warren Buffett's net worth?
80 something.
How much?
80 something.
Millions? Billions, thank you. 89 billion exactly. Thank you very much. So Benjamin Graham is the author of Security Analysis, which is seen as a Bible of investing, as well as The Intelligent Investor. If you have heard about that book, it is free on YouTube. You can go and listen to it. It'll probably cost you 13 hours of your time, but $0. All right. Warren Buffett popularized the idea of value investing, and since then there have been hundreds, if not thousands, of people who have adopted that philosophy and have become extremely successful. You will see some of those people in the next slide, and as I said, it will be no surprise to you after you've seen those people why I have adopted that philosophy.
Oh, even Michael reaching too.
The value investing philosophy is founded on the basis of 3 things primarily. It requires for us to understand a business that we're going to invest in. Secondly, it requires for us to know the value of that business, which is why a stock at 50 cents is not necessarily a cheap stock. For that stock at 50 cents might only really be valued at 10 cents. So if you buy it at 50 cents, it means you are paying 5 times what it's actually worth. You do not want to be on that side of the tree. All right? And then lastly, we want to buy the shares in the companies that we understand and have an idea of what they're worth when they are on sale. That is, when they are selling below what they're worth. So we want to buy, say, $10 value stock at $1, for example. $7, if it's worth $10 and you buy it at $7, that's still a really good position to be in. And that difference, we call that a margin of safety. It means that you're buying something that you know is worth more. All right? And that's one of the 4 principles of value investing. Do you recognize any of these people?
What? Manish Pabrai?
Okay. So going from the left, this is Warren Buffett, net worth, $89 million.
Manish.
This is Manish Pabrai. He has a very interesting book called The Dando Investor. I highly recommend it.
Sick.
His net worth, I believe, is within the tens of millions. I don't remember the exact number.
Okay.
I'm supposed to know because I know my billionaires.
Oh,
And then, the Honorable Michael Leachin, net worth, I believe, is $3.6 billion US. All right. So, does it make sense now that if all of these are value investors, that I would want to adopt the philosophy that they've used to build their wealth? Make sense? I think so. So now we look at the 7 P's of successful value investing. The first one is profitability. Value investors invest in companies that are profitable. You would think that that is common sense, but it is not.
Oh dear.
I'll give you a famous example of, or rather, a famous company that actually came to market without being profitable. And you probably all have the app on your phones. It's called Snapchat. When Snapchat came to the market, Snapchat had a valuation per share of around $17. Romario, am I correct? Around $17 Snapchat came out at?
I really don't remember.
Alright, look it up. I think it's $17.
Oh dear.
Within the next few months after its IPO, y'all know what an IPO is. Alright? So within the next few months of the IPO, the stock went from $17 to $11.
Yeah, what's
You know why? Right?
Yeah, you're right.
You want to know why? Snapchat was not profitable. It kept losing money. And so whilst persons bought into the hype of Snapchat because it had 3 point something million daily active users, or whatever that number was, the company itself that owned the application, the one that you were investing in, was not a profitable company, and they continued to make losses. The other caveat to this, because as I mentioned, you want to know what the value of a company is. So we knew that Snapchat was not worth $17. We also knew it was worth more than $11. The value investors would have been buying Snapchat at $11. And you would actually be up today. I don't know what the quoted value is today, but I'm sure somebody can tell me that by the end of the class, or by the end of the presentation. All right? The other two points, we make a distinction between profitability and profitability. Profitability is your, rather, let's call it the promise that you will be profit in the future based on your operations. That is sometimes a good selling point. I am far more comfortable when a company can show me that you are profitable and you're growing profits year over year. And then lastly, as value investors, we must not only look at the history of the company through its profitability ratios, but we also want to make sure that we're looking through the lens of the company's ability to realize continuous and growing profits into the future. So if I'm buying the company today, I want to know that 10 years from now, the company is worth more. All right? So that's the first thing that the value investors want to look at. When Michael Leachin bought NCB was still a very profitable company. And I'll tell you just a short story about NCB. My mentor bought his NCB shares 20 years ago at $2 per share. Does anybody know what NCB shares trade at? Okay, guess the perfect time. 200? That's a guess? Well, very accurate guess, sir. Because yes, today NCB trades at $200 per share. The second P is people. So when you're investing in a company, there are two things we need to understand, and value investors will always tell you this. When you're investing in a company, you're investing in a business, but you're also investing, and possibly more importantly, in the people that operate that business. A great saying from Warren Buffett is that if you give a jockey a goat to race, he's going to come in last. But if you give a novice a racehorse, he's going to still win the race over the jockey. What he's saying is that it is not necessarily the vehicle, but rather the person that is managing the vehicle. So you want to know that the people who are managing your company, the company that you have invested in, are competent, they are reliable, they are trustworthy, And there are people who have an eye for actually growing the business. Another thing you probably want to look at is if they are personally invested in the company themselves. Alright? On the flip side of that, if the people that are managing the company are not competent, they don't have integrity, and they're not looking to grow the company or even take a stake in it into the future, then they have, for want of a better word, less impetus to get your company to be as profitable as it can. The third P, can you all see that? I know it's very tiny. But the third P is practicality. Value investors like simple, practical businesses. One of the businesses that value investors love to invest in are essential services. Think banking, think real estate, think food, think water, think electricity. Anybody got Wheaton shares? No? And we have words with the president. But if you are investing as a value investor, we tend to look at essential services and apply all 7 P's to making our assessment as to whether or not we want to invest in that company. Y'all with me so far? There are only 7 of them, so we have 3 more to go. Okay. Forgive that mistake. So the 4th P is price. Now, despite you having a business that you understand, despite it being run by competent management, despite the fact that the company has the ability to be more profitable into the future, the company has a price that it is worth. And this is not always equal to what the stock market says it is. That's what creates the opportunity. As value investors, we're only using the market to say, is this company where I want to buy it in terms of its price? Or is it in a state of being what we call overvalued, giving me then an opportunity to sell the shares at a profit? Because remember, earlier we spoke about buying the shares below what they're worth. So if we know what the value of the company is, we now need to look at the price to see what the relationship between the value of the company is and what the price on the stock market is. And that will determine what decision we make. Make sense? So value investors will look at price, but it is not the major thing that we look at. We have to look at all of these in the context of what the company is doing. And of course the prospects of the company. Another thing, and we could talk about this for days, the psychology of the market. You can read this slide, but basically what it's saying is that psychology creates opportunities within the market because there are people who will react based on what is happening with the stock market. So for example, let's run through a scenario. What if you bought what's a hot IPO?
Mailpack.
Mailpack.
Well,
so
wait.
Mailpack is doing an IPO. All right. Let us say the prospectus comes out, and you hear every single body talking about him going to buy Mailpack shares. What that means there's a positive psychology around the stock, and you as an investor can play on that. I can give you many historical examples of this. The lab was one very good example. The lab was one of the most anticipated IPOs of this year. The stock came out at $1, and literally within the span of 2 weeks, it went up to $4. So it's important to understand the psychology of the market. And this works both ways. Because if there's negative sentiment around a stock, it's going to go from $10 to $1 real quick. Alright? So you need to kind of consider that when you're choosing the investments to make. And you need to then look at how you can capitalize on what the current psychology of the market is. Now I can tell you that the current psychology of the Jamaica stock market is heavily positive, or is heavily bullish. Alright? That's the psychology around the market. Especially with us now being featured, I don't know if you would have seen it, But yesterday, the Jamaican flag was on the door of the
Shanghai
New York Stock Exchange.
Oh, okay.
And the reason for that was because of the performance of the JC. If you had invested in the entire index of the Jamaica Stock Exchange 5 years ago, you'd have reaped approximately 230% on your investment. That is not to say that companies haven't performed badly, because there are companies that have. I won't name examples here. I charge you to go and research those. But there are also companies that have done exceedingly better than that 233%. Barry, thank you very much. 600+% in just 1 year, by the way. All right? And those are all sentiments, those are all results, rather, of a very bullish stock market. I want to, before moving to the next point, I just want to say here that the sentiment, there are two things that can actually affect sentiment. It could be fundamentals, or just the word I want to use is feeling. Jamaica is benefiting from both of those at this point in time. You would have seen where the economic data is saying we have record low unemployment, we have record high net international reserves, and our economy is now actually starting to see growth.
Policy rates drop too.
The 6P, and I alluded to this earlier, but this is performance. We want to know, because when you're buying into, I'll complete the thought. We want to know that a company has historically performed up to the point that we're buying it, and has the potential to perform even better into the future. And that is why it's important to look at performance. Another reason it's important to look at performance is because no company operates in a vacuum. Meaning, a company is not just out there and is just making money. There are things that are going to happen that are outside the control of the directors of the company, of the shareholders, and of the other stakeholders that will cause the company to either perform better. Think about construction in Jamaica now and what that could do for, say, a company like Caribbean Cement or Lumber Depot, which is another IPO that's slated to come on. Or there are legislation. There are other sentiments then that could affect the company in a negative light. Think about increasing taxes on cigarettes and what that could do to the profits of, say, a company like Carreras. See? So we want to understand what the historical performance of the company has been, and probably even project what future performance might be. We call this creating the story. That's what value investors call this. All right? So a story would be like, since 2013, Access Financial has grown revenues, or earnings in this case, from just over, I want to estimate that at 150 million to 500 million. All right? So that's a story. Now what we investigate is what happened throughout these years that actually caused Access Financial finances, or the performance, to look this good. And then we want to look at the current state of the market to ascertain whether or not this performance is going to continue into the future. And then the last one is patience. And the slide says it all. The stock market, again, it is said that in the long run, the stock market is a weighing machine. Meaning, it's how long you can wait for your company to perform. It's how long you can wait for a stock that you've been watching to reach an attractive price for you. That attractive price being less than what the company is actually worth. It's how long you can wait for an initiative that a company is embarking on to start generating profits, such that the market is then able to appreciate the value of the company. All right? And so I'll just use those 3 points to say patience in investing is one of the most, sorry, not one of, it is the most important thing. I will close by saying that these 7 principles for value investing do not exist in isolation. A good or successful value investor is a person who has basically adopted all of these 7 principles and uses them in combination to create opportunities for themselves. All right? And these are the things that produce the Warren Buffetts, the Michael Lee Chins, the Monish Pabrais, the Howard Markses of today. All right? And that's it. And thank you very much. Okay, so if you have any questions, I can take them at this point.
Alright, when first investing in a company, are you aware of the minimum requirement? The minimum amount you can invest?
Yes.
Oh.
No. That's a tricky question in the sense that the minimum that you can invest will vary based on the situation as well as the company's share price. Situation, let me explain that. If a company is say if you're investing at the stage of an IPO, then the company determines what the minimum amount of shares you can purchase are. You're going to multiply that minimum by what the share price of the company is, and then you're going to add whatever fees. Typically, there's a charge of $163, and that's the only additional charge when you're investing in an IPO. So you can see why there's a big gap. Let's look at 2 examples. When the lab came out, you were able to buy a minimum of 1,000 shares, was it? 1,000 shares. The share price was $1 per share. So you could have gotten into the lab with $1,163.50. Understand? By contrast, when Caribbean Property Value Fund was coming out, their share price was $34 something.
46.
46 per 1 year.
46.
Thank you. It's now at 34.
Yeah.
That's a buy opportunity. And that is not investment advice, I'm just saying.
After the DCF. After the
But
DCF.
46. And they also stipulated what the minimum was. So again, you have to multiply those two, add the fees, and then see what the minimum is. So that's situational. Generally now, if you're buying shares from on the trading floor of the Jamaica Stock Exchange through your broker, then you want the minimum amount of shares that you can buy is 100 units. You're going to take that 100 units, multiply it by the share price that the company you're interested in is, and then you're going to apply the fees. The fees typically come out to around 2% all things considered, maximum 3%. So there is the commission, which most brokerage houses have reduced to 0.75%. There is a trade fee. There is a cess fee, which I believe the JC has now waived. There is
Tax.
GCT on the value of the fees, though, not on the value of the entire transaction. So the minimum varies. I'll answer a question that you alluded to, but you didn't ask it. Meaning, how much does it take to really start investing? You told them?
None.
Well, it varies. Different brokers have different requirements. For instance, I'll give you an example. Mayberry Investments, if you want to buy equities through Mayberry Investments, the minimum is $1 million.
Same for Jiggy.
JMB probably like $5,000.
No, it's actually $1,000 now.
$1,000 now?
Yeah.
It was $5,000 before.
It was.
Yeah,
It was.
we
It
reduced
was.
it.
You see that?
Yes, it varies. Yeah, it varies. But generally though, on the Jamaica Stock Exchange, whenever you're buying equities, you just need to buy a minimum. You have to buy a minimum of 100 units. So it's 100 times whatever the stock price is.
Right. So that will be the general answer. All right. Any other?
Do you have any reading material you recommend?